Today we're talking about reasons why people choose not to invest in the stock market. Going back all the way to 1926 through 2022, we're looking through some of the major reasons why people did not want to invest. And were they right? We'll see coming up next. Hey, this is Mel Stubbs. I'm a financial planner here at Christy Capital Management, and today we're looking at the excuses people use to not invest in the stock market. I came across this chart that shows from 1926 all the way to 2022 the main reasons why people chose not to invest. I'll have this list of reasons shown right over here. You remember the 1929 stock market crash. In 1933, Hitler became German chancellor. In 1939, World War II begins. 1941 was Pearl Harbor. If we fast forward some, in 1963, Kennedy was assassinated. 1968, Martin Luther King Jr. was assassinated. In 1982 was the worst recession in 40 years. Why would you want to invest then? In 1986 was the Chornobyl nuclear accident. 1987 was Black Monday and that really big stock market drop. 1990 was the Persian Gulf crisis. In 1998, President Clinton was impeached. 1999 was the Y2K scare. 2000 was the technology bubble burst. 2008 was the worst market conditions since the 1930s. 2012 was the financial woes in Greece. I remember that being a big deal. 2016 was Brexit. 2020 was the COVID-19 pandemic. 2021 was the meme stock craze. And now in 2022, it's the highest inflation since the 80s. With all of these reasons, it's a pretty good argument for not investing in the stock market. But then look at this. If you would have invested $10,000 in the S&P 500 index in 1928, it would be worth $2.5 million as of March 2022. Now, yes, you can zoom in here and you see the dot-com crash where the market came down a good bit. You look at 2008, there was that crash where the market came down some. But if you look over time, the stock market always seems to work itself out. Now, does this mean that you should have 100% of your money in the stock market? No, it doesn't. You need to work with someone to help figure out how much risk is appropriate for you to take. You may not need to have all of your money in the stock market, but should you have some of your money in the stock market? Possibly. There'll always be reasons why the market outlook looks horrible and you should not be invested. But in hindsight, when you look back, the American economy seems to always push through. This chart shows an annualized return of 6.2%. Now, there's a saying that it's not timing the market, it's time in the market. Now, just a couple of months ago in January 2022, we were at an all-time high in the stock market. Now, by definition, an all-time high means that the stock market has rebounded from every low it's ever had. Now, past performance is never a guarantee of how things will behave in the future, but when you think the outlook is dim, do remember that having stock market exposure helps you in retirement planning to, number one, offset inflation risk, which is the risk that prices keep going higher and higher, and we're experiencing that right now. The stock market also offsets longevity risk, which is the risk that you live a really, really long time, and you need to make sure that your money lasts as long as you do. So the name of the game is to have the appropriate amount of stock market exposure that suits your needs and your goals. I read a quote one time that said, "You only see what you look for." So if you look for reasons why you should not invest in the stock market, I'm sure you'll find reasons why you should not invest in the stock market. But if you look for reasons why you should invest, I'm sure you'll find those reasons as well. If you want to work with a company that can set up a financial plan for you, that can also set up an investment strategy for you that you can stick with, whether the stock market's doing amazing or whether it's not, reach out to Christy Capital Management. We'll run through several scenarios, including what if the stock market returns low returns over a long stretch of time? You need to make sure your plan can withstand poor returns. Go to our website, christycapital.com. Give us a call on the number on your screen. On the website, you can go up to the Talk with an Advisor, fill out some information, and we will be in contact with you. If you enjoyed this video, please consider subscribing. My name is Mel Stubbs. I'll talk to you on the next video. We need to do the proper disclaimers. The purpose of this video is not to give specific tax advice or investment advice. We're going over general principles and ideas that can be used, and if used correctly, can save and avoid taxes. You're going to want to work with someone personally who knows your situation personally. So seek out advice from an independent financial advisor. This is for educational purposes only. I hope you enjoyed the video.